Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to look at something very simple and brief. We are going to look at financial management and corporate strategy, or you can also say corporate strategy and financial management. We want to look at the link between the corporate strategy at large and the role of financial management in corporate strategy. That is what we are looking at. Now, these are two different things. We have already looked at what financial management is all about. Even though on this channel we are here to look at corporate strategy, but that is not what I'm going to do now. I'll do that later. But I'm just going to give you the basic definition of what corporate strategy is all about. Corporate strategy is basically about a strategy that is developed by the board or top management, which actually determines the scope of an organization and its direction in the longer term. Okay, so corporate strategy is more about long-term direction of an organization, the scope of the organization, and then this corporate strategy is expected to achieve advantage, a competitive advantage in the longer term. All right, so we are looking at the direction of an organization that encompasses every other function that organization plays in a long term. That is what corporate strategy is all about. Even though I've not given you the concrete definition of corporate strategy, but I'm sure that I have helped you to get an insight as to what it's all about. Now, financial management is very fundamental to corporate strategy because while the corporate strategy looks at the scope and direction of an organization in the longer term, financial management is that fundamental thing that you need, because in all that you are planning, in all the direction, with all the corporate objectives that you are going to set, the long-term goals and then the short-term objectives, whatever that you are going to do involves money, and that the management of funds is always fundamental to corporate strategy. And that is why it is almost impossible to separate financial management from corporate strategy. Now, therefore, it means that the financial manager is expected to align the financial goals or financial aims of the organization with that of the larger corporate strategy. Now, you know, when corporate strategy is set, that there are levels of strategic objectives. Okay, we have the corporate level objectives, we have the business level, and then we have the operational level. All that, we'll look at that when we are dealing with strategic management. But I want you to understand that whether at the corporate level, which encompasses all the strategic business units, or at the business level, which deals with one business unit, or at the operational level, no matter the level of strategy, you need financial management as the fundamental thing that you need to look at, because in all that we are planning and strategizing will involve money. So the goal of financial management is to align with that of the larger corporate strategy. So actually it is corporate strategy and financial management, okay, even though I have written it as financial management and corporate strategy. However, corporate strategy is larger, and then we need to align the goals of the financial department or the finance department to that of the larger corporate strategy, because finance department is there to help achieve the corporate strategy. And that is what we are going to look at. Now, in looking at this, the most important or the key thing that we have to look at as far as a business is concerned is to look at the financial objectives of an organization or a business. Let me use the word business because we also look at the financial objectives of a non-business. Now, for now, we are looking at the financial objectives of a business. And when I say financial objectives of a business, we know that a business is a profit motive organization. All right, and that is what we are looking at. So, financial objectives of a business. And when I say a business, there are so many types of businesses. So you should know that it applies to all of them, whether it's a sole trader business, a partnership business, a company. We are looking at financial objectives of a business. But in this sense, we are mostly focused on the corporate bodies, the companies. But then you should understand that what I'm putting here applies to all businesses. When we are done with looking at the financial objectives of a business that should help us in achieving the corporate strategy, then we'll also look at the financial objectives of non-businesses or non-profit making organizations, and then we'll be done with this. Now, financial objectives of a business are basically four. The first one that should help us achieve the corporate strategy is maximizing of shareholders' wealth. So shareholders' wealth maximization. Maximizing the shareholders' wealth. I'm going to explain them. And then also, we will look at maximizing profits as another objective of a business. And for the records, I'm sure by now you know that there is a difference between profit and wealth. We'll look at that as well. And then also, there is something called satisficing. Some businesses have that as the objective. And then we'll look at finally earnings per share growth, even though it is not so much key. These three are very key, but then earnings per share growth is also an objective of a business. And in this case, from the way we are planning it out, it applies more to a company, but then it can equally apply to any other business. So let's take note. Now, financial objectives of a business or a company. The first one is the maximization of shareholders' wealth. And then we'll look at maximization of profit, even though it's not listed in any particular order. Satisficing is another objective, and then earnings per share growth. Okay. Now, I'm going to briefly explain these ones, and then we'll look at the financial objectives of a non-business. Now, what do we mean by maximizing shareholders' wealth? Shareholders' wealth. Now, even though there are 4 financial objectives listed here, financial experts say that the key objective of every business is to maximize shareholders' wealth. So that is very fundamental. Now, who are shareholders? Shareholders are the owners of the company or the organization or the business in this case. Now, they are equity shareholders who have contributed their money in a form of shares for the business to run. Now, before they invest in those equity shares, their objective or what they want is to be wealthy. And the organization or the company must work hard to maximize the wealth. Now, how is wealth maximization measured? Simply, the easiest way to look at wealth maximization is when the market price of the share is growing up or growing. So let's assume that at the time that the shareholder bought the share, it was $5 per share. Now, in the next 10 years, if you are able to grow the share price to, let's say, $15 per share, then what you have added is that you have added wealth of $10 per share to the shareholder. So depending on the number of shares that he holds, this $10 times the number of shares is an additional wealth that you have created, because if they want to dispose of or sell their shares today in the stock market, they are going to get this much gain on their share price. That is what we call maximization of shareholders' wealth. And that is the major objective of every business, to maximize your shareholders' wealth. Now, the next one is similar, maximization of profit. Now, there is a difference between profit and then shareholders' wealth, and I'm going to look at the difference. Now, profit is short-term, and it includes some accrual basis. Now, when we talk about profit is basically what you achieve in the long term. Maximization of shareholders' wealth is about the long term. Now, if I want to give you some more differences, I'll tell you that to maximize profit and to differentiate it from maximization of wealth, you will see that profit itself is in a short term. So there is a short-termism with profit, but the wealth is usually in the long term. So take note. And then also, maximization of the wealth has to do with cash basis, but profit includes accrual basis. So cash basis versus accrual basis. So what I want you to understand is that in maximizing shareholders' wealth, you are more concerned in the long term, but in maximizing profit, it's about short term. In maximizing shareholders' wealth, your focus is on cash basis. The shareholder is concerned about the cash return from the sale of the asset. But when it comes to the profits, we are concerned, we use the accrual basis. Okay, so I keep telling my students that profit has so many disadvantages. You can make profit and you still have no cash on you. The shareholders are more concerned with the cash growth than with this. And then also, profit, there is risk associated with profit. Okay, profit is risky than that of some shareholders. Management will take a lot of risk. Some management take a lot of risk just to increase their profits and maybe pay themselves bonuses and all that. Even though shareholders, or let me say that profit maximization has a link with shareholders' wealth maximization, but that is not what they are looking for. Because when you maximize profits and their share price is not growing on the stock market, they don't see that you are doing them any favor. Okay, so shareholders expect chiefly their wealth to maximize, and then when profits are going up, that is also a plus and still will attract some kind of investment. But then they are more focused on the wealth maximization than profit maximization. And that is what I want you to understand. Now, the next thing that we look at as an objective of a business is called satisficing. Now, what is satisficing? Satisficing simply means, let me just make profit for survival. Most businesses are not concerned about growth. Their concern is just survival. And those businesses, we say they are practicing what we call satisficing. They just want to satisfy a level of profit only to keep them in business. They don't care about some level of growth in the long term that other businesses are striving for. There are some businesses whose aim is just to survive. So they just make little profits, pay shareholders some level of dividends, maintain a little for expansion. Even if it doesn't expand, fine, they are cool. Once they are not collapsing and they are surviving, they are okay. And that practice or that objective is called satisficing. So satisficing is about operating for survival and not for growth. Now, the last one, earnings per share growth. Now, this one, in some manuals, you realize that they will not add the earnings per share growth because it's kind of relates to the profit maximization. Because once your profit is going up, it means that your earnings per share will also go up. But somehow, it's not always the case. Okay, that is why I choose to separate. Some manuals also choose to separate, like I have done. Now, what we are trying to say is that these are 4 basic financial objectives of a business, which must align with the corporate strategy. We are saying that the aim of financial management is to align the financial objectives with a larger corporate strategy. Now, regardless of the nature of the organization or the business and its corporate strategy, you should, as a financial manager, be able to align these goals with that of the larger company or the corporate strategy of the organization. And that is what we are talking about. So these are financial objectives of a business. Now, having done this, we are finally going to look at the financial objectives of a non-profit making organization or a non-business. We're going to look at, so if businesses have this as their financial objectives, then what about organizations that are not set up for profit? What is going to be their financial objectives? That is what we are going to look at. Okay. So now let's look at financial objectives of a non-profit making organization. Financial objectives of a non-profit making organization. Now, non-profit making organizations are non-businesses. They are not established with the aim of making profit. Usually they are established with the aim of providing services to the community and then basic needs to the people. They can be government institutions, government organizations, NGOs or NPOs, and all other institutions that are set up not to make profit, but to offer community service and other basic needs to the people. Now, the major constraint of such an organization is the ability to raise funds. The fundraising or ability to generate money is their major organization because they are not operating for profit. And therefore, the major constraint is to raise funds. And because they find it difficult to raise funds, they have 3 key objectives, okay, that they want to achieve. But we put those 3 together and we call it value for money. So the main and the only objective of a non-profit organization is to achieve value for money. The main and the only, I repeat, the only major objective financially of a non-trading or a non-profit making organization like a government institution, an NGO, is to obtain or achieve value for money. Now, how is this value for money achieved? Now, value for money is achieved from 3 parameters. So there are 3 different objectives, or let me call it sub-objectives, that when they achieve, then overall they have achieved the value for money. Okay, now what is the meaning of value for money? And that is what I'm going to break it down. When I break it down, you realize that in achieving those 3 sub-objectives, then you are actually achieving value for money. Now, the first one is called economy. Now, the second one is called effectiveness. And the last one is called efficiency. So usually we call these ones the 3 E's: economy, effectiveness, and efficiency. Now, in achieving these 3, then we say you are achieving value for money. So value for money is when the organization is achieving economy of its resources, effectiveness in the use of financial resources, and efficiency in the use of financial resources. That is when we say the organization is achieving value for money. And that is the major financial goal or objective of every non-trading organization or even a government institution. Is their performance in terms of financial performance is measured by how they achieve this value for money. And it is also measured using these 3 parameters: economy, effectiveness, and efficiency. Now, let me explain each of them for you, beginning with economy. What is the meaning of economy? Economy of resources means that you are acquiring your input or your raw materials or whatever that you use, you are acquiring them at the least possible cost. That is when we say the organization is achieving economy or you are being economical. It means that to be economical and achieve value for money at the end, then you should procure your goods or your services at the least possible cost. That is why when a government organization is being audited, okay, they are always audited for value for money. So when you could have bought this marker for 10 cedi and you pass by the least possible marker, especially, in fact, even though we look at quality, okay, but assuming that you have this marker and there is another one of the same quality and of the same brand sold by different sellers, and one seller is selling it for 10 cedis or $10 and the other one for $15, and you skip the one who is selling for $10 or submitted a bid for $10, and then you choose the supplier who will give it to you for $15, auditors will raise a query on you because you are not achieving economy, and in so doing you are not contributing or achieving value for money. Because to achieve value for money, you need to be able to achieve this economy, which is very important. You need to be economical. You need to procure your inputs at the least possible cost, whilst you are not compromising your quality. That is very important. So that is what we call economy. And in other words, even when you are embarking on a project, the cost that you are incurring on a project should not outweigh the benefits that you are going to get from the project. When you are doing that, it means you are not achieving economy. And by so doing, you are not achieving value for money in the public sector or any other non-trading organization. Now, when it comes to effectiveness, effectiveness means doing the right thing. The right thing that must be done is what you are doing. You are not doing something that is wrong. So in doing the right thing in a non-profit making organization, you are also achieving value for money. So what must be done is what should be done. You are not going to do something that is not a priority, that is something that shouldn't be done now for selfish interest. When you do so, you are not achieving effectiveness. To be effective, you need to do the right thing with your financial resources. So you are not going to do impulse buying. What you need to buy is what you buy. What you need to do is what you do. In other words, you are doing the right thing with your financial spending. That is effectiveness. And to be efficient, it means that you are doing the right thing well. So you can be doing the right thing, you can be effective, but you are not efficient. To be effective and not efficient means that you are supposed to buy this marker, you are buying it. But are you buying it at the right time? Are you buying it at the minimum cost? Are you buying it from the right supplier, the right quality? Now, if you are not doing the right thing well, then you are not being efficient. Efficiency means that being able to do the right thing with the least level of resources. So if I can construct this building, that is, in fact, we need to construct this. If I can do it with 58 million, and another person will do the same building with the same quality with 40 million. Now, we've both done the right thing. We've been able to, especially when we're given a timeline, both of us may have been able to do it within the timeline, but I did it economically, and it means I was very efficient. So efficiency means that with the least input, you'll be able to do the right thing. That is what efficiency is about. So please take note. Economy is doing the things with the less cost. Effectiveness means doing the right thing, and then efficiency means doing the right thing well. You are doing it, but you are doing it well. So you can be doing the right thing, but you are doing it not well. That is what we are trying to say. And in achieving these three, then together we achieve the value for money. And that is the financial objective of a non-profit making organization. And I'm sure this is very understandable. All right, so having explained this will bring us to an end of this video. Now, in our next video, we are going to look at stakeholders and the agency theory. Okay, and then we are also going to look at the economic environment of financial management before we begin to move into some other calculations with financial management. Remember to subscribe to this channel if it is your first time. Share this video, let others also have a benefit. And until we meet again for another video, it's bye for now. Thank you.